record to Awesome. Hey, welcome everyone to another weekly Live with Caeli show. Today is July 19th, 2022, and the world is melting. It is hot everywhere. So we expect there to be probably no one on the call. And of course, I am wrong out of the gate, Caeli. There are people here who are looking to find out more information from Caeli Ridge and Ridge Lending Group. We're going to be admitting everybody in as they come. For those that have joined, thank you very much for coming. We do always look forward to speaking with you. And we are here today to talk about a summer book club with Ridge Lending Group. We're going to ask you some feedback on that and get some voices back from the community on what you think we should review as far as a book and talk about chapter by chapter. Those are always fun. And then separately, we are going to go through some open Q&A. If anybody has any questions. And then lastly, I think we need to talk again a little bit about the all-in-one loan that has come up probably 4 or 5 times at least so far in the last few months. And so I think there are some general questions that some folks want to really understand because we've been seeing a lot of those requests. So if you have any questions for Caeli during today's show, of course, either speak up by taking yourself off of mute, or feel free to use the chat if you're not really one to speak live like that, or you're not in a place to. And then if you have any questions after today's show, if you're watching this on replay, always call in to 855-74-RIDGE and talk with Caeli or any other dedicated lending specialist about what you need, or you can email at info@ridgelendinggroup.com. So Caeli, welcome.
Thank you, Larry. Good afternoon, everyone. Happy to be with you this afternoon. I think I missed last week. Larry, thank you for handling that for everybody and being such a valuable asset to all of us. So Larry came to me with this idea about a book club, right? A couple of weeks ago, we had a little bit of back and forth. I loved the idea, but I had to tell him I had to actually call myself out and admit that the amount of time it's been since I've read a book for business or pleasure, that's not true. I have to read books for compliance and continuing education and things like that. But for, actively investing or my own pleasure, it's maybe been 10 years. Now, in fairness to myself, I do read all the publications and the newsletters and things. So I do have my finger on the pulse, but it's been a while since I've read a book related to real estate investing, regardless of the strategy that may be imposed. So we thought it would be a great opportunity to get our listeners' take on the books that they're reading. We'll bring them into the fold, and whether we go chapter by chapter or maybe we take excerpts and discuss them from maybe a lending or underwriting perspective, if that's useful, or just dig into some of the strategy around those and some of the differing thoughts or opinions about them. I thought that would be really cool. So for now, and then at the end of our time today, we'll just do a Q&A. Anybody has particular scenarios that they want to run or something that's come across their desk that they thought was interesting or whatever it may be, let's start talking about that. But for now, I'd really be interested. It looks like we've got a nice intimate group here. I'd be interested to know what books you guys are reading, right? And what is the content out there that you're seeing that you found most valuable? I can see my buddy Axel's on here. I guarantee he's going to have a good recommendation for us. So what do you guys got? Who's reading what?
Does Business Week count? So Axel is reading The Changing World Order. I think I certainly haven't seen anything come out recently by Ray Dalio. We will have to check that out, Axel. See?
Is it real estate, Axel?
We're gonna look it up. We're gonna look it up right now.
Okay, we're gonna look it up.
We're gonna look it up. The Changing World Order. Is this a very dark book, Axel? Is this what you're recommending here? Let's see.
Money and Economics. Okay.
So it is a must-read of the year according to Amazon. It's #1 New York Times bestseller. A provocative new book. No empire lasts forever. Okay, that's a great one. Have you read it, Axel, or are you in the middle of reading it? Oh, you've read it. Great. Okay, so good
What
read.
do you recommend?
Snorefest, audiobook only. What do you? What should we do here, Axel? Give us some guidance. And while Axel's responding here, for those that are just joining, audio plus downloadable PDF, that's actually cool. I like those kinds of books. Anything downloadable PDF is great. So what we're talking about here for those folks just joining is we Ridge Lending Group we want to take some of this time and do it as a book club. So if you have any real estate books that you wanted to read or have read or have been recommended to you, I've done this with some other things in the past, and Caeli and I talked, and we thought it might be a great opportunity to review the book together and at least give some insights and banter about some of the concepts within that. So
Yeah,
we had a great first suggestion from Axel, excuse me.
Yeah, if you guys have any books, real estate books specifically, and not, I guess, but ideally real estate centered that you have read that have helped shape your ideals or your thought process about whatever strategy, long-term, short-term, fix and flip or whatever, we want to hear about it, and we'll start taking polls, and then we'll bring those to our groups here that are listening and provide, I think we'll be able to, I wonder if we could even provide access to digital versions of that to the people that want to read it. Could we, Larry?
It depends on the copyright, right?
Yeah.
So if it's something that is shareable, absolutely. But if it's something that's copywritten or is on for sale, probably not. You probably have to invest in yourself and get a copy.
Amazon it, yeah.
Yeah. Publishers gotta get paid, Caeli.
I get it. Anybody have anything? I'm thinking that there's not going to be too much.
So last week, Caeli, we had a chance to go through a lot of guidelines rather. Sorry, I thought there might be some questions, but go ahead. You have a book recommendation. I'm not sure who you are.
Oh, I don't know why my name's not showing up, but
I'm a Zoom user.
I'm a Zoom user. My name's Patty Toohey.
Oh, hi, Patty.
Hi.
Hi,
Hey,
Patty.
Larry. Hi, Caeli, I guess. Caeli. I have a meeting with you tomorrow, Caeli.
Great.
Over the phone. I'm plugged into Michael Zuber.
Okay.
He is a California guy, and I just ordered his book. He has 2 books. This one's called One Rental at a Time.
See that?
And he's got another one he sent me called Conversations with 15 Real Estate Millionaires. And he signs the books, which is kind of cool.
That is cool.
He's got a podcast I listen to every day. And he reports on daily news. It's 9 minutes. It's every morning. And he talks about short-term rentals, long-term rentals. And as an investor, I find him very interesting. So he's got books, podcasts, videos, all kinds of stuff. And he's done the hard stuff. He's, gone broke. He's a multi-millionaire, but he's preaches to the layman. He speaks in our terms.
Awesome. Well, thank you very much for the recommendation, Patty.
I recommend him.
Thank you.
I like that. I think maybe we'll check it out, Larry. Maybe we start with that, and we'll just maybe do chapter at a time. Thank you.
We'll see if anybody has any other seconds to that or any other suggestions, Patty. That's great. Thank you.
Well, Julie, if you want to know, if you click on those 3 little buttons, dots at the top right of your picture, that's where you can put your name.
Oh,
you can rename yourself. I personally like Zoom user. I think it's great.
I'll work on it. Thank you.
Very, very clever. I usually I think we would play games on people in the corporate, and we administratively we would rename people what we thought they should be called. So, Zoom user sounds great. Awesome. So in the chat also, there's two more recommendations from Axel, the fiat standard and the fourth turning. I wish I had as much time to read as you, Axel. I'm very, very envious that you've made it through. I think I've made it through 2 books in the last 2 years. So
Axel's very, very studious, and he makes the time. It's just you can, by talking to him, you just know that he's very well read.
That's true. You do have to hand water your garden. It's very prophetic. It's very, very prophetic. So so last week, Caeli, because I know you weren't here, and I haven't put the replay. Shame on me. I had some unexpected travel last week, which is my go-to excuse, but it's true. Because I'm getting yelled at from our producers to get that thing up so we can get it promoted. It will get up over the next 48 hours. Anyway, in that we went through our V series and our D series. One of the things we didn't talk about, Caeli, at length, we went into a little bit of detail, but at length was getting in and closing things like blankets or cross-collateralization. I know you've talked about that. And so we did talk about closing in the LLC. We did talk about the 2 to 8 units with the mixed use. And we did talk about the 5 to 8 units residential in the V series for that. So if anyone has any questions, if you were on the meeting with me last week, if you have any questions about any of that, because I didn't put the replay up, so shame on me, certainly let us know through here. But
Talk about cross-collateralization maybe real quick.
yeah, because that's something that I'm sure people may have heard of, but
Yeah.
it's one of those things like you don't really hear about. You just heard somebody mention, you're like, what the heck is that?
Yeah. And I'll tell you that it's becoming a lot more prevalent in my day-to-day conversations. People are looking at that. And the language barrier for lending is tough, right? You've got one thing that can mean 4 different things depending on the context of the discussion. So it's learning a new language. So for that purpose, a lot of times when we talk about cross-collateralization, people might know that as a portfolio loan, for example, or a blanket loan, for example. What's happening here on the residential side is that we're taking single family up to 4 units. That maintains residential distinction. Anything over 4 units is now commercial, but single family up to 4 units, any combination of those, and we're taking all of these residential properties and putting them into one cross-collateralized, right? The debt is collateralized over a cross of all those properties into one blanket loan. And what I'm finding in the conversations that I'm having actually is that there's some really savvy investors out there that see the writing on the wall, and what they're doing is they're preparing. They're taking their stabilized portfolios and they're putting them into whatever number of properties that is. They're putting them into this one blanket loan, which is non-recourse. And that distinction means that all of those that maybe held conventional financing before will no longer count against their Fannie Freddie 10. So let's do an example. Let's say that they have 10 single family properties, okay, and 7 of them are stabilized. And by stabilized, I mean that they've had them for a good 2 years. It depends, but 18, 2 years, 3 years, 4 years, whatever, stabilized, right? They've got the tenants are in there, the properties are now on the tax returns for that many years, whether it's short-term or long-term, it really doesn't matter. But they're going to take these properties and they're going to put them into one non-recourse loan, which means, what did I say? 7 of the 10? What number did I use?
Yes,
they're taking 7 of the 10 that they have, and they're going to put it into one non-recourse loan. So what they've done is they've just opened up 7 new Fannie Freddie conventional loan spots. Non-recourse means no personal guarantee, which means they are no longer going to count against that conforming 10 limit. The reason that they're doing this is that they know that in the next 12 to 18 to 24 months, rates will come back down, right? That's just what rates do. And they want to be in a position at that point to refinance maybe into a lower 30-year fixed, if that were the case. So they're using it right now as a vehicle to leverage or harvest equity more often than not, cross-collateralize non-recourse to open up spots for more purchasing or whatever they want to do down the road. And it's interest only. The one that we're doing most of is an ARM, adjustable rate mortgage, on an interest only, which is also giving us the benefit of the better cash flow. So cross-collateralization seems to be on the rise as far as what's coming across my desk.
Do you want to get into the specifics, Caeli? Last week, I literally had up on screen a sanitized version of some of our guidelines that just spelled out LTVs, credit limits, those kinds of things.
Sure.
So Axel he's asking some specifics about what's your max LTV for non-recourse, those kinds of things.
Okay, let's go through just kind of play by play. So 80% loan to value is allowed. And if it's a small portfolio, the debt service coverage ratio. So just to back up and clarify, we are not looking at you as the individual for a debt to income ratio. We're going to look at your credit score and we're going to look at your assets and things, but this is a debt service coverage ratio, where all we care about is the property's income divided by the monthly payment. Okay, we don't care about your DTI, debt to income ratio. So on a small portfolio, which is 1 property to 4 properties, we're going to take 90% of the gross rents and divide that by the ITIA, interest, taxes, insurance, association dues, if it applies, because these are interest only, ITIA. We're going to divide that, and we need to see a 1.0 or greater. 1.0 or greater means that the rents and the total payment are the same number. That is 1.0. So if the rents were 1,000 and the payment total all in is 1,000, that division is going to give you a 1.0 debt service coverage ratio. So you need to be at 1.0 or greater on a small portfolio. On a large portfolio, 5 to 10 properties, it needs to be 1.1 or greater. So same math, 90% of the gross rents divided by the ITIA, interest, taxes, insurance, and association. 80% loan to value is applicable. You can choose from a 5, 7, or 10-year interest only. Each of these have a prepayment penalty associated with them. The 5-year has a 3-year prepayment penalty. The 7-year has a 4-year prepayment penalty. The 10-year has a 5-year prepayment penalty. The prepayment penalties are a waterfall or a stair step, which means 3-2-1, 4-3-2-1, 5-4-3-2-1, respectively, for the 5, 7, and 10-year. What that means is, let's just take the 5-year, it seems to be the most common, is that the prepayment penalty is good for 3 years, but the penalty will be 3-2-1. So in year 1 of the 5 years, if you try to get out of this loan, you're going to pay 3% on the outstanding principal balance. Let's just say easy math is 100 grand. So 3% on 100 grand is $3,000 is what you're going to pay to refinance or sell that property to get out of that loan. In year 2, it goes down to 2% of the outstanding principal balance. And in year 3, it goes down to 1% of the outstanding principal balance. After the 3rd years, there's no more prepayment penalty. Interest rates associated with this are running between roughly 6.99 and 7.5, depending on the variables. Credit score, whether you're closing in an entity, your experience as an investor, all of those things can dictate what the interest rate is. And for each subsequent term, 5, 7, or 10, you can increase the rate by 1/4 percentage point. So if you were at 7% on a 5-year, you're going to be at 7.25 for a 7-year and 7.5 for a 10-year.
There will be a quiz about this in 5 seconds, just so everybody knows.
You're all taking notes.
How about that it's not in every state?
Yes, that is true. It's not in every state. The list is pretty long, so it'd be easier for me to somebody say, ask me a state, and I can look it up really quickly for you.
I have it over on my left, screen in case, just because
you got it ready.
I'm ready. I'm ready.
I got it ready.
I'm ready. So just to kind of give Caeli a chance to breathe, this is I think so as far as Alabama, no. As far as Florida, yes, with an asterisk. So part of these guidelines, right, Caeli, is some states you're allowed to do it as a person, some states you're not. There are intricacies about this product, and I would definitely encourage, if you've got a specific scenario, you got to get a hold of either Caeli or call in and talk to your dedicated lending specialist.
Yeah. So you could do it either way, guys. You could do it as an entity or as an individual, I believe. Are you saying that there's some states that you can't do it one or the other?
Yeah. In the guidelines. Okay. Yeah. So there's some states that you cannot do it. There's very few, but some states you cannot do it as an entity. North Carolina is yes, Zoom user. Patty.
Now, keep in mind too, I wonder how that applies to the rate, because if it's not allowed in that state, because if you don't, on this product, if you close in your individual name, there's a 0.25% hit to the rate. So you want to close in your entity, your LLC. We find that that's normally not a problem for anybody. Most people want to close in their LLC anyway for the non-recourse. But I wonder, Larry, if the rate or the pricing, they
I would expect it doesn't matter. Just because you can't doesn't mean you shouldn't have to, doesn't mean you don't pay for it. I would expect so. So yeah, I'm gonna say the list just because it's gonna be recorded. Okay. And as of today, April, listen to me, July 19th, 2022, it's Arizona, California, Colorado, Washington, DC, Florida, Georgia, Hawaii. I'm excited about that one. Idaho, Illinois, Indiana, Louisiana, Massachusetts.
That's an MA,
MA
yeah.
is like Massachusetts, Maryland, Michigan, Minnesota, North Carolina, New Jersey, Nevada, Ohio, Oklahoma, Oregon, Pennsylvania, South Carolina, Tennessee, Texas, Utah, Virginia, Washington, and Wisconsin. And what I'll do is when we do the replay for this, I'll put those states in the replay, so you don't have to worry about making notes. And I think we should also do a list, Caeli, for which state has that asterisk where you have to close in an LLC or you can't close in an entity.
Okay.
So Eddie says, my lender, probably the New York guy, right, Eddie? Said to me, we need to close in an LLC or entity. Yeah, because they probably they don't want you to borrow. They don't want to lend to you as a person. They want to lend to your company.
Non-recourse.
Non-recourse. And so Patty, what we've been talking about are, we started with blanket. So that's how Caeli got into this topic, but these kinds of loans are not limited to blankets. They can be for single properties, can't they, Caeli?
They absolutely can. And they can be for, I believe, yeah, they can be for 5 to 10 unit apartment complexes as well. So that's not technically a cross-collateralization. That's just one property on one tax lot. But the one we are talking about, yeah, it can be for a single family residence or a 4-unit, or it could be for 6 single family residences or 3 fourplexes and 2 duplexes and a condo, right? It's one state. Okay, so this particular investor that we're reselling to, and just to clarify, guys, we are a direct lender in that we underwrite and fund in-house on our warehouse line, et cetera, but we don't service these loans. So what that means is that we take them and we bundle them and we will sell them back to an aggregator, what we call an aggregator, or an investor that will then take and run with the servicing, however that ends up working out. So the state, this particular who we're talking about right here, the properties have to be in the same state. So if you had a portfolio of 10 properties and 4 of them were in Washington and 3 were in South Carolina and another 3 were in Florida, and you wanted to cross-collateralize, you'd be looking at 3 different blanket loans. Does that make sense, right? They will not allow us to have different assets in that packaged portfolio loan in different states, which I never really understood. Larry, do you know the answer to that? Because I don't know why investors have such a problem with that.
It's state laws for foreclosure, because if you want to file foreclosure to file across 3 different states is very costly, if even possible. I'm not sure.
Okay, well, that's a very easy answer. I probably should have thought about that.
It's always about the foreclosure. It's always about taking the property.
Right, default, right. Right. I mean, they've got in the event of default, they have to have that protection.
Got it. So on this, to kind of round this out, Sean, thanks for the question. Well, I'm going to tackle that right next. So if anybody has any questions, I did want to point out, this is, again, one of those things where you don't have to have perfect credit, do you, Caeli? In other words, credit score.
Yeah, in fact, let me pull that up. The minimum credit score is quite low, actually, if memory serves. If you want to grab another question, or everybody just hold on a second, I'll tell you what that is.
Yeah, that, and then also if you, again, because I'm not sure who always listens to our podcasts or where everybody is in the country or in the world right now, but there is a caveat too for foreign nationals, I think, on this too.
We can do foreign nationals, absolutely. Yep. Foreign nationals and the lower credit scores are going to be a little bit limited in LTV. Let me give that to you. So for foreign nationals, you're at about 65 to 70% LTV max, depending on the transaction type. The credit score goes all the way down to 600.
Crazy.
That's pretty low. I mean, so if something's happened, right, that that was just the situation, it'll go as low as 600, and you're looking at 70 and 70, depending on your experience as an investor. It can be between 65 and 75% LTV. If you've got no experience as an investor, you're going to be limited to probably 65%. If you have more experience, 70 and 75%. If you had a 600 to a 639 credit score, they go in
phenomenal.
tiers. Yeah.
That's great.
Yeah.
That's great stuff. Yeah, if anybody has any more questions about this, again, 855-74-RIDGE or email to info@ridgelendinggroup.com. Sean asks, Caeli, what your take is on the investor being able to buy as an individual, but then transfer the deed to the LLC without activating the due on sale clause.
It's such a good question, Sean, and I should let you know, and everybody else listening, that rule no longer applies. Fannie, Freddie do no longer apply the due on sale as long as, and we should have this in the community, Larry. So I don't know where it is.
Yeah,
Okay.
I'll actually post in the Sean. I'll try and grab the link before we go out of this. So I'll post it in the chat. But yeah, we actually do a full article on this.
I'm going to show you guys. I'm just going to share my screen real quick since we're asking, so you can see it. There we go. So this is what Larry is going to share with you guys. You'll have this. This is straight seller's guide. This is straight from Fannie Freddie. They're virtually the same between the two of them. And when you see this, you'll scroll down and the highlighted section is what you're going to be looking for. This is a language that specifies what you have to do, the individual, in order to avoid due on sale when you're taking from your individual name and putting it into your LLC. Basically, what this is telling you is that you have to have the majority interest in the LLC. Okay, so if you transfer and it's a single member, you're fine. If it's a multi-member, you need to have the majority interest in that entity. Anyway, all of this will be there, almost identical from Fannie to Freddie, and yeah.
The link's in the chat. Obviously, everybody here should be a community member, so it should take you directly to that article. And there are both the Fannie due on sale and the Freddie due on sale PDFs are there for you. Okay, Sean, you want to be like Sean Zoom? Yeah, we could change you to that if you want. He was talking about changing his name in the chat. Awesome.
Yeah, thanks, guys. I'm sorry for the C behind me. I just want to say hi. I hate being on there just as Sean. Caeli, you've already helped
Hi,
me.
Sean.
Trying to hide or anything, but I can't change my name. I've Googled it and everything, so I apologize.
What do you want to change it to? I could change it here for
I
you.
just want Sean Hart on there.
Okay,
I'm
I'll
trying
change
to
it for you.
establish a relationship with
Oh my
Caeli,
gosh.
and I'm on there as Sean. I'm like, I'm spending an hour trying to do this on Google, and I can't. There's no 3 dots for me.
Look at that.
All
All you had to do was ask, and there it is. It's
Oh
done.
my goodness. Thanks, Larry. You're
Now, I
full
can't
service.
promise that'll be there tomorrow, but it's there right now.
Full service. I love it. Thank you both for everything you're doing.
It's our pleasure. And if we need, I can always grab one of my teenagers to come by for one of the live events that could help us figure it out in a second. That's my go-to.
Like that. They figured it out like that.
Yeah.
Thank you, guys.
You're welcome. Thanks, Sean.
Nothing like having teenagers to make you feel really, really technologically inadequate. It's a good time.
I agree. And I think the as far as the for those, there were a few people that joined very, very late. So if anybody has, anybody has any book recommendations, one of the things that Caeli and I talked about and prep for today's meeting was that it might be great. Not everybody has time to read, or maybe you read something and it's been a while and you want to revisit it. And we can do this as a group. We can record, in these group meetings, some of the concepts and share ideas back and forth about what works for you or what doesn't, and explore a couple of different books. So if you have something that you've either read or you've thought about reading and just like me, don't have that much time, but you'd love to explore it together as a group, go ahead and either throw in the suggestion into chat. And also, if you're watching this on replay, go ahead and post it in the comment in the community. So Kay, whoever Kay is, they're hiding their identity, Caeli.
They need help. They need your help.
Yeah, they need help. This is
Karen.
Karen, all right. So tell me more about your question. What about the income approach?
From an appraisal, Kyron, are you talking about qualifying, or are you in a place where you could unmute maybe, or you need to keep chat?
I don't know. You let me know.
You're good.
There it is.
So one of my friends was mentioning about, he called it the income approach.
That sounds
But-
appraisal to me, because could
Okay.
he been talking about an appraisal, like the way you value an asset, you can,
I
there's
think
a,
you're right. I think that's what he was talking about. Like he has two properties that obviously during this time period has skyrocketed. And he was trying to do what you were talking about, like a blanket concept to where he can put it all together, non-recourse, free up what he needs to free up. And I was like, man, I don't know nothing about that. I said, you need to call, you need to call Ridge
say,
because
yeah.
I can't help you with that one.
Well, the income approach from an appraisal perspective, more, I would say, Larry, you may have to help me out here, but from valuating the asset, we're going to mostly take the market sales, right? We're going to take the sold comps in the area, the appraiser, not we. The third party appraiser is going to take the comparables meaning like kind, square footage, age, bedroom, bathroom, vicinity, distance, all of that stuff of what's actually sold. Now, I know that they're going to take pending sales in there sometimes too. They will give us an income approach valuation, but that's not the one that we're going to use to calculate what your loan to value is going to be and how much money you're going to get. We're going to take the market sales. So that I think that works to what he's saying anyway. If the value has gone up because there are sales that support that higher price, then that's probably what we're going to see on the appraisal anyway. If in income approach, he's saying income of the property to qualify, maybe.
So he was saying like the way he was wording it was like, let's say the rent was X amount of dollars, but doing income approach would then value the property at this number. So
That's
let's just say,
that's a commercial approach, right? So commercial lenders, Kyron, commercial lenders only primarily use income valuation as their primary basis for determining what their appetite on that property is for lending, because it's all about return on investment based upon your rent rolls. So if the property, so in this particular example, if we're talking about specifically commercial lending, as it relates to residential lending, which is what Ridge Lending does, the best way to match those up is to think about debt service coverage. So it's not going to change your ability to for the value of the home in terms of loan to value, like Caeli was saying, because there is no such vehicle within residential lending. That's strictly a commercial avenue to determine the value of a property.
so the only thing that he would, well, the only option he has if he wants to do the, as he calls it, the income approach or commercial, he would have to go commercial where they would look at the numbers, see what the rents are coming in, and then whatever cap rates, yada, yada, they would value it based upon whatever. And then that would take him out of obviously the residential loan he has and put him in a commercial loan.
Yeah, typically when you're dealing with somebody who when you're dealing with a lender, and a good example of this is if you take a warehouse, like a building, a retail store, doesn't matter. You take a commercial building. If nobody's in that building, what is it worth? And then now put somebody in there who's paying $30,000 a month. What is that building worth? The answer is a lot more when there's a $30,000 a month paycheck coming in.
Roger.
Especially if there's a long-term lease, those kinds of things. But again, all of that is well outside the boundaries of, anything that we would typically talk about in residential lending.
Appreciate it.
Good
Yeah,
time, Kyron.
yeah, Karen, thanks. Yeah, it's confusing, right, Caeli? Because on every residential appraisal, when it
They
has
have it on there.
rents, there's an income approach.
Yeah.
And so people see it and they're like, oh, well, according to the income approach, my property could be worth a lot more than the sales. 100%. It's very confusing.
That was his exact reason. He was like,
Yeah.
my income approach says that this is worth, I don't know, let's say $500,000. He said, well, I want to do the income approach. And it's like,
Yeah.
I know it's funny because a lot of turnkeys or real estate agents in the space that maybe are newer to the space, they assume that we should be able to use that. And if, let's say, we get an appraisal back that comes in under value of what they had told their buyer it was supposed to be, they'll try to dispute or rebut the valuation and offer income approach data that it's just not, it's not how it's going to work for what is applicable to what we do here on the residential side of investing.
Yeah.
So anyway, that was good. I don't think
That's
that's
really
something we
good.
talk about too much.
It is, yeah, we don't see that very often, but it does come up. Tracking.
He's following us. He's military.
Oh,
I got you.
you got to
Hi.
back me up on that one. I can only keep up so often. So so as we round out today's call, we had a chance to go through, get your weight up. Is that another thing? Charlie, is that him calling me too thin? Do I need to lift weights? Like, what does that mean? Interpret, please.
Go ahead, KF.
That means you need to get a little bit more knowledgeable. Get your weight up, son.
I bet you got a million of these, right? That's just like, I'm gonna look like a fool here. So anyway, for those, we'd love to hear, we'd love to hear if you have any other questions on guidelines or qualifying. That's what we do. We want to make sure you're educated as much as possible. Caeli, any interesting situations as we round this out? Maybe one last comment. Any interesting situations from borrowers? Because I know you talk to borrowers all day long.
Yeah.
Sorry to put you on the spot.
Yes. No, it's okay. I talked to someone on Saturday who has a more complicated scenario, and he's got other avenues for investments, and what I walked away from that conversation thinking is that, without sounding braggadocious here, I do think, you guys, we are uniquely qualified to understand from your own personal perspectives what it is you want to accomplish, and put those pieces to the puzzle together from what we know we have to subscribe to, all of the products that we have access to, and all of the underlying guidelines that attach to each of them, and can really help you organize those thoughts and then display them and then take action accordingly. That actually is action steps that get you closer to those goals. I felt pretty good because he was super complicated, and he had me spinning. I mean, we went in 10 different directions inside 20 minutes, but by the end of the call, it was a longer call. I think that we ended with a really solid plan for him that was actionable, concise, relatable, in layman's terms. So I don't know that was necessary to share, but that was my most recent call. You said something about the all-in-one. Did anybody have any questions about the all-in-one?
Yeah, so, thank you very much, because I lost track of that one. So with the all-in-one, I think the bigger thing that's come up recently that I thought was important to talk about was honestly that it becomes your checking account. I think that's something that it's not just a loan product. And so, it is one of those things where it requires a paradigm shift to how you're living your day and how you're running your business, especially with regards to using that account as a clearinghouse, which is what it's built for, to reduce the interest that you're accruing on that mortgage.
Yeah, there's a compounding effect that's at play here, guys. There's two compounding effects, actually. So if you think about your mortgage as a HELOC, which is open-ended and revolving, okay, the mortgage that you have now is probably closed-ended and it's amortized. Closed-ended meaning if I sent $5,000 in with my mortgage payment, what happens to that $5,000? It's stuck in there. It's gone. I can't get it back, right? How would I get it back? What's the only way I can get that back out of there? Cash out refi, right? A full cash out refi with the costs and the brain damage and the vials of blood, and that's the only way you're going to get that cash back out there. An open-ended revolving, I can throw $5,000 in there, and the interest accrual is going to be based off of the balance on that day. There's a snapshot taken every single day within a 30-day billing cycle. And the more of my income that I have access to, all of my gross rents, my paycheck, my dividends, my Social Security, my child support, my alimony, my retirement, whatever it is, I'm throwing it in there in this account, and I'm driving down whatever my mortgage balance is dollar for dollar, so that every day when they take that snapshot, the interest accrual is based on the balance. And if my depository money is in there, my balance is going to be lower. And the longer that I can keep it in there within that 30-day billing cycle, the less interest can accrue on a monthly basis. That's compounding effect number one. So you're going to want to do this every single month. You're going to get all your income. You're going to throw it in there. You're not going to touch it for, say, 29 days. But throughout the month, so that you can live, you're going to use your credit card probably as a, you know, an optimization tool. We tell our clients to pick your favorite credit card that gives you your miles, whatever, and you're going to pay for your food and your gas, your mortgage payments, your car payment, your utilities, down to a stick of gum is going to go on that credit card. Before the credit card accrues any interest, right, on day 29, you're going to go online to where your money's been sitting, and it houses your mortgage too, and you're going to pay it off. You're going to pay the credit card off. You're going to do this every single month. Compounding effect number 2. Whatever is left over after all of your expenses are paid, let's say that you have $10,000 in there of your income, and then on the 29th, when you go to pay off your credit card, you paid $8 grand. You have $2,000 left. That $2,000 sits in there and it stays in there every single month. But guess what? You have access to it, what? 24/7. The money is exactly the same use as if it was in your Wells Fargo account. Nothing changes about your income or your spending habits. You're simply taking the income from the vessel that it's in now, your depository stuff, all sources here, and you're sticking it here. You've become your own bank within the all-in-one. For the right individual, this is hands down the best loan product, particularly for investors, that, in my opinion, on the planet. There is not a better loan product for an investor than the all-in-one for the right for the right investor or the right individual, you know, whether you're an investor or not. If you are spending more than you make, this is not the right loan for you. You are better served on a 30-year fixed. But if you have discretionary income of maybe 10% is kind of that threshold. So if you made $10,000 a month and you have about $1,000 left over as a minimum, chances are the all-in-one is going to smoke the 30-year fixed. Because remember, on a 30-year fixed mortgage, if you take a loan out for $100,000, how much interest are you paying over 30 years? Anybody have a rough idea? Double, twice, at least, depending on the interest rate, et cetera. The all-in-one is going to greatly reduce the amount of interest that can accrue because you've got all that depository money sitting in there day after day, month after month, accessible to you 24/7. It's called the all-in-one because it's fully functional. An FDIC insured bank is who houses this, okay? And all the same banking features. Routing numbers, online bill pay, paper checks, debit cards, imaging systems. If you guys get paper checks for your rents, right? I mean, if somebody's still doing that, or you get a paper check for whatever, you can take a picture of it with your phone. And if you have the app, you'll upload it to your account. Anyway, I kind of went down a rabbit hole, didn't I? Any questions about this?
You did great. You did good. So for those that are asking, I put a link in the chat for the product description. There is a simulator on our site that kind of goes
cool.
through very, very basic things for what Caeli's talking about. Honestly, because it is a different kind of product, it's not meant for everyone. So we do very strongly suggest you know, before you get too far, especially trying your own simulator, just get somebody on the phone from Ridge and they'll walk you through the simulator. It'll save you a lot of time and explanation. The APR. So the APR depends on a lot of things for what you're doing on there. It is an adjustable rate mortgage, right, Caeli? So there's a margin plus an index.
Correct. You can do a monthly, or you can lock it for 3 years. There's a 3-year fixed option for this. Margin and index is the answer to that, Kyron. I'd have to answer it for you individually. But Larry, what do you think about maybe once a month doing I don't know, a 3 o'clock Pacific or 2 o'clock Pacific, 5 o'clock East, I don't know, where I do the simulator. Someone can be a guinea pig and we'll do the simulator together, or I'll just make up a scenario, because the simulator, you guys, it's on our site. Play around with the simulator. The problem with the simulator doing it on your own is that you may not know what the simulator is. You may be interpreting what it's asking as something that it isn't asking. And if it's bad data in, you're not going to get the right results. So, and it's super easy intake. It's three quick intake pages. There's no vials of blood here. Very, very simple. But I do think that if you're just doing it for the first time, it might be useful to have somebody walking through what the fields are asking for specifically, so that you get it right and the results are accurate. Maybe we'll do that, Larry. Maybe one day in August, we'll promote an all-in-one simulator crash course, and you guys can jump on and just watch me go through it and see.
We'll just take a Tuesday. I think if we collect for next week, we'll get the book club running, and then, you know, we'll maybe use next week for the simulator, like a full walkthrough. So Karen, Caeli, please correct me, but depending on how long it takes to get the appraisal done, to get one from application turned in with everything signed to closing, 30 days or less. Is that still fair?
No, all-in-one, it's very, very highly sought after, you guys. We're finding that the all-in-one takes closer to 45 days.
There you go, 45 days. So there you go for that. And Nancy asked, as far as minimum value, I reversed that. And so the minimum loan amount
100,000.
is 100,000. So if you go, Nancy, to 80% loan to value, minimum
Primary
value
only.
125, and then it goes down less if it's not your primary. As far as loan to value.
Correct.
Sean Hart, got you on there, Sean. So Sean says, heard Caeli on the rental income podcast this week. Great sample phone call from Tina. Tina's a real
Thank you.
person.
Yes,
I actually
yes.
talked to Tina when she came into Rich.
You did. You did.
She's really good stuff from Caeli, and always, although not a book, I recommend the podcast to rookies. Yeah, that's a rental income podcast. So I'd love to sit down and tell RLG where we are. I think our phone lines are open now, Sean H. So call whenever you're ready. No, seriously. I mean, there's a ton of great people that can help. So thank you for that feedback. And yeah, I think that's, you can get an all-in-one KF on your, sorry, that was what Caeli said. So I'm just going with it. It's a military thing, I guess. So a primary and a second home and an investor. So you can only get 3 max, 1 on each occupancy.
And that may be to your disadvantage, right? You may not want 3.
Yeah.
Because if you're taking your depository income and it's $5,000 a month and you're having to divvy it out against 3 of those properties, it probably ends up defeating the purpose. I mean, individual scenario, we'd have to look at it, but maybe.
Business account, we heard, 2 weeks ago, there was a client who wanted to have one on his primary because that's what he wanted to put all his personal stuff through. And then he had one for his business and on an investment property. And that's what he wanted to put all his business deposits through. So I don't know what the results of the simulator were. So I don't know if that was the best solution, but that's why it's important to talk and go through it, right, Caeli?
The math won't lie, exactly. Like I always say, the math won't lie. So when we
Gotta
look
get you
at
that
it,
t-shirt.
we
Gotta
decide.
get
I know I'm gonna get a t-shirt that says the math won't lie, or maybe a tattoo on my forehead. Is that what you're
No,
gonna
a
do?
hat. Just a hat.
Oh, okay, yeah, okay.
No tattoos.
Like,
Not
I
on your
know.
forehead.
No, I'm not. Yeah, I'm too old for tattoos. I'm past that.
Okay, so last questions, once, twice. So next week we will, I'll put the word out and we'll do the simulator next week, Caeli. Are we good with your schedule for that?
No, it'll have to be the week after. Haha, he caught me. He did that on purpose. I know he did that on purpose.
I did not. I promise I didn't.
I'm out
So next week we will go through some more information. If you have any questions in preparation for that, please let us know. You can post it on the community or send it into info@ridgelendinggroup.com. And as always, Caeli, we greatly appreciate your time and your information and your guidance. So thank
Love
you.
being here. Thank you, Larry. Thank you guys for showing.
Okay,
Talk
everybody.
soon.
Have a great
Bye,
rest of
guys.
your day.
Very
Thank you.
much.
Bye-bye.
Thank you, guys.
Thank you.